Hello, everybody. Back to our webinar series, developing superb trading strategies. Yeah, my name, as always, Stefan Friedrichowski. I think that is now commonly known. And today we have the 9th of March 2017, 11 o'clock German time. So everything as usual, so to say. And by the way, many thanks to ArgusFX, who makes that webinar series possible for all of us. And I think that is something worth to mention every time. Yeah, as always, once again, the so-called risk warning. You know that I have always to mention that because we talk about trading strategies, but finally, if you do your own trading activities, of course, you do it on your own, as I mentioned, and that has to be mentioned here during the webinar as well. Good. Topics for today. Yeah, we went last week a little bit through that topic, reverse trading, but as I mentioned at that time, there are two possible methodologies of how to reverse or how to mirror those trades. And one method we have discussed already last week, and today I will briefly go through that other method as well. And what means here continuation as well, because out of that common approach, and still I say, hey, reverse trading itself doesn't work, but out of those analysis we have done already, and I have done some additional analysis during the week, it's possible to really come into this developing of the real trading strategy and not something what I would not do like reverse trading. So anyhow, you will see, I think it's quite interesting because we can get once again some overall conclusions which help us for developing of trading strategies. The other topic which I, last week I skipped because there was no time left, was the update on the seasonal DAX trading based on a week of day trading. So the reason to update that strategy is quite simple, because Peter Müller has developed the related expert advisor. So now it's time to have the final parameters for that strategy. And by the way, with the third part, I will start because I know that going on with those activities around reverse trading and the conclusions and the follow-up out of that will take much more time. And before I once again skip the DAX seasonal, so I reverse the order compared to what I have written here. And now in 1 month is over, so it's a good time to have a review on the performance of the Lamda strategies at ArgusFX. So I will go there as well. Good. Questions have not reached me during the last week, so we can skip that topic first, but then go directly into the week of day seasonal trading of DAX, or I wrote in brackets FDAX, because it's a mixture between trading the normal DAX and the real FDAX, but you will see later. So I think in October we have had a webinar for that topic as well in general. So if you want to have more details on that, no problem. Simply go to October within my YouTube channel, and by the way, you find that YouTube channel in the PDF document I have already uploaded, so the current slides are uploaded, so you can download slides and then you have all the links. So basically, what does it mean going with week of day trading of FDAX? Now, let me do the steps directly here within Excel, because that is what I want to do anyhow. And the second purpose here, doing that online to update that strategy, that you in general can realize, hey, how what I have to do if I have something like an Excel sheet like this here, and I want to have an update, so new prices downloaded from a website, and then go on with that strategy, and even a new run for optimization of the parameters. So in short, how does strategy work? So that works, or the analysis within that Excel sheet is based on the day of week. So first question, and I go briefly through it, has been, hey, what are the changes, the overall typical changes during one day during the last 15 or 14 or now 16 years? And so you get the first picture here, the bar graph, and you see that the overall change related to the day of week, there is no real dependency. But the good thing is we can say, okay, let's have a look for those days individual for long and short, and with an additional filter. And the additional filter is simply called bull bear, so bearish or bullish. And the definition, there's just a simple definition of whether I call the market bearish or bullish, and that's only based on an EMA. And if the price is above that EMA, then I call that market a bullish market, and if the price, the close of the day, is below the EMA, I call that market bearish. So quite simple definition, but let's see what that kind of filter does with the typical movement of a day related to the day of the week. And now it comes out that we get a surprising result. So you can see that the different days, the day of the weeks, behave completely different. So if we have a bullish market, for example, so price is above the EMA, and we have Tuesday, then it's a good time to go short and not long. So even if that we are in a bullish market, the typical Tuesday on such a day goes to the south. Same applies for Wednesday. Only Monday, Thursday, and Friday, they behave bullish. And we get exactly the opposite. If we are in a bearish market, then on Tuesdays, it's a good time to go long and not short. And that is indicated by those bars here within the chart. And what we have done is we have simply applied those rules. So first rule, distinguish between bullish market and bearish market. And second, the day of the week. So we have an EMA, which we can shift around. And finally, I don't go to all the details of the Excel sheet, but finally what we have is we have a stop loss for both for long trades and short trades, for bearish markets and bullish markets, but I use the same stop loss for both trading directions. So we have a stop loss, and yeah, but we don't have a take profit. How does it work? So in the morning, and since the data are based on FDAX, in the morning at 8 o'clock, we look are we above or below the EMA, and we immediately open at 8 o'clock a position into the direction depending on that table here. So it depends on whether we are in a bullish or bearish market, and it depends on the day of week, and that fixes what trade direction we enter. And the trade is entered with a stop loss of 1.1%. So that is the last optimization here. So you see, and then we get trades. Those trades are closed only by two conditions: reaching stop loss, the 1.1%, or we have the end of the day. So there's no take profit for that strategy, but we close the trade at 10 o'clock in the evening, regarding less where we are. Profit, loss, doesn't matter. At the end of the day, the trade is closed. So there's no take profit itself, but we close the trade by a time stop if not reached the stop loss during the day. So that's all. We don't have overnight positions, and you can see the equity line here in units of R. So as always, I trade here with units of R, and that's the final result here. But now let's have a look about where we are time-wise with the strategy. And time-wise, we have data until 24 of May of last year. So now it's time to update the strategy. And how to update? Quite simple. So I go here for that website. The website is called Stock. A little bit strange spelling, at least for everybody in Germany. So it's stooq.com, and on that website we can have a look for DAX. And if I simply enter DAX, then you can see, hey, here's a DAX future, and that are the data we take, and we need new data. And we need data from 25th of May 2016, and those are the data we need. So now I have pressed that button, then I go for download, and those data are coming here directly, and I can open those quite easily, downloads. So here we are, and I do a double click on that one here. It's a text file with the data, and starting with 25th of May last year. And now I can go simply taking those data until yesterday and can complete everything here, or copy those data here. And now I have all the data within my Excel sheet, and now I have to update all the lines, and that is quite easy. You go to the end, and I put one here, and now I can copy everything here, and doing so, then I have all the data within the Excel sheet. So everything is done here, and let me zoom a little bit, that it will be a little bit bigger now. So what are the next changes? There are some additional changes to be done, and that is quite easy, because if you see here doing that kind of analysis, there are steps like average of all those cells within Excel, and now the list is a little bit longer. So let me look where we are. We go down to line 4640. So I have to change that here, 4640, and I have to update all those cells here as well. So that is one update. It will not change really a lot, but you will see now doing the same for the different days or weeks. It will change the numbers slightly, but no change in sign. That means the definition of what day should be traded in what direction is simply still the same. So now here we have to change again, 640. Let me check. Yeah, everything is right. And doing the same step here, everything is right. So all those steps are done. And finally, I do the same here. And I do the same here. Okay, so that was a complete update process. The only thing left is I do it only in one graph, and that graph is here. So in the equity graph, I have to update the line as well. So edit and change the datas. So a few steps in Excel just needed for that updating process, and then we are nearly done, and we can have a look on the strategy once again, just from what comes out. Good. So those steps are needed. Sorry, I have to revisit here. It takes a little bit of time always because the computer is quite busy. So I have a fixed timeline here, so I have to change that as well. Let's do it automatically, so then everything is done. What we can already realize here just by our eyes, that especially in the last couple of months, that strategy was not working that good. But now I de-zoom here a little bit. I mentioned that I want to finalize the strategy in terms of that I want to update the parameters and have a look what kind of parameters are good. And we don't have that much parameters, but let me do here the other steps as well. So I want to have my single number as always, and that number is called opti, and that opti is simply the profit per day. Oops. The profit per day divided, no, it's vice versa. It's maximum drawdown divided by profit per day, because that gives me a good number. I have to change here a little bit more. Oh no, that was already the profit factor. Okay, let's optimize against that, and that's all. So the only thing we need, I want to have the EMA value here, so that 80 should be right here, because then I don't have to scroll anymore again. So I want to have that number to be set already here, so I can change now the two numbers of the strategy, and the two numbers of that strategy are only EMA, and since most stop losses are absolutely the same for long trades and short trades, I only have to consider those two numbers, and that is what I need for optimizing that kind of strategy. Let me just change here the numbers, like EMA, I go now for 10, for example, and you can see immediately the result for the strategy. And what you can see is that in the beginning, of 2000 and the next coming years, there was very strange behavior, but then the strategy absolutely works well. So we have an easy way here to optimize the strategy. Going a little bit higher with the EMA helps, and what you can do always is you can have a look to that number here, and if that number is going south, so it's getting smaller, then strategy is better. And that's not only by eye, so we visualize the equity line here, but the number which really describes the strategy by a single number is this one here, and the lower the better. So moving around the EMA, and you see, wow, this 1,300 is a little bit better, and now 40 is even better, and going up to the values we have had originally. Let's go for 80, for example. That was not that bad. So what we realize here, 40 is a little bit better. And now let's revisit the numbers for stop loss and change around that number within the Excel sheet, and we can see whether it's going better or worse. So we start with 1.1, that was a little bit better. Now it goes worse once again. Let me go a little bit more upwards. Okay. Doesn't seem really to help. With higher numbers, now it goes a little bit better, changing around. But what you see is, hey, the 1.1 is not that bad. So what is the downside of that strategy? Downside, clearly seen here, the maximum drawdown or the drawdown phase here, is higher. And let me check one thing here, because I'm not sure. Yeah, no, that number is right. So that was only a check whether I have the right maximum drawdown. Okay, what I know now is, I know that during the last couple of months, strategy was not that good, but the overall behavior for the last 16 years was quite well. So for me personally, that parameter set is already good enough. And what I know and what is good, that moving around with those numbers doesn't really make the strategy bad. And that is what I always call a robust strategy, because that strategy doesn't really depend on the parameters, and that helps a lot in order to go on with this strategy. So I have done that kind of analysis already previously. So what I have done finally, I have everything settled here for the expert advisor. And you see there's an ongoing trade right now as we speak. Today, it's Wednesday. We are in a bullish market, so we are above the EMA. So and Wednesday is a day for going into the direction, and therefore we open that trade into the long direction. Okay, so everything set, everything settled, strategy is running, so it works, and you have seen how to optimize such a strategy and how to update the strategy here. Good. So everything is done. I can go to the next topic. By the way, if you have interest in the Excel sheet, I can send it around. No problem. Just send me an email to friedrichowski@ArgusFX.com, and you have access to that Excel sheet as well. Good. So that's for today. No, I'm not ready with my webinar. No, sorry. I go on with our topic we started last week, that was all around reverse trading. So let me recap a little bit what we have done, and we have done some analysis already. So the the idea or the question behind is that within social trading platforms, you find the opportunity to, or at least at some platforms, that you can click a button, which means I want to reverse every trade. And that means finally the trade is mirrored. In a sense, a long trade will be a short trade in your account, and vice versa. So, and the principal idea behind is, if I look to an account which is not profitable, I go for the reverse trades in order to get profitable trades. Yeah, I know that that thinking is wrong. I mentioned it already last week. There are only some theoretical arguments for that kind of trading. But nevertheless, I want to show it really, and that it doesn't work. And simultaneously, that analysis offers or opens a new view on trading itself, because there are some new hints how we can go further. So what we did last week, or just let me describe what I will do online once again here. I have a C program which can run on M5 datas, so it's nearly 1 million of lines, not the code of lines, it's the data, 1 million candles if you consider M5 data since 2004, and I simply have fixed some numbers, like I give every trade a maximum duration of 1 week, and I use 2 parameters to describe, it's not really a strategy, but to describe those trades. One is a stop loss, which is based on a multiple of the ATR, and I have CRV, or in English it's the risk-reward ratio, which is variable, so we can change around that risk-reward ratio. Yeah, and the next rule is here that we don't have too many trades for that analysis. I have simply fixed the rule that only if the price changes enough compared to the last open of a trade based on an ATR, then I open a new trade. What does it mean? So if I open a trade now and 5 minutes later the price would not change during the next 5 minutes, more or less, then I would not open a trade for the next candle, because we have still the same situation. So only if the 2 entries are far enough away from each other, then I open the next trade. So it simply reduces the number of trades. What we calculate here is we calculate all equity lines for short and long trades and the sum of both. And doing that kind of approach, I encountered that there are in principle 2 variants of how to mirror a trade. And last week we have been completely only into the variant 2, and that variant is best described by that if we open a long trade with, for example, 1% stop loss and 3% take profit, then the short trade will be opened at the same point in time, so more or less the same price, but still I use 1% stop loss for the short trade as well, and the 3% for the take profit. So that is variant 2, and we got a lot of conclusions out of that. And by the way, later we go on exactly with variant 2 as a base for further analysis. So conclusions to mention here, that simply that mirroring in that way doesn't work. But what we realized, and that was quite surprisingly, at least, let's say for me, if we always go for 2 trades simultaneously, one short trade and one long trade, and if we have a little bit higher risk-reward ratios, then the final equity line of both this all long and all short trades has been positive, at least without spread. That is surprisingly, because if the price, and we use euro US dollar data, would be completely random, it should not work. So that is a very good confirmation that finally the price is not completely random, and that's a, a good conclusion for trading, because if the prices would be completely random, then we would not have any chance to have profitable strategies. Looking or going through the analysis of last week, we realized, okay, if we now enter some spread values as well, that kind of strategy in principle is not any longer profitable, but we realize that there are some phases being still profitable. So the question was, hey, can we find a suitable filter to filter those trades which are indeed profitable? But before going on with that, and I can promise you, yes, there are some certain filters, and we will derive those filters later. First to the other question of the other type of mirroring. So the other type of mirroring is maybe best described in a chart first. So let me have any symbol here with a new chart. And let me go for M5 data here only because I use later M5 data as well. And I use euro US dollar later. And let me once again describe the other way of mirroring. Think about a trade which is, for example, opened here. So that is the open of that trade, and we want to open at that price level, for example, a long and a short trade. Let's first say, okay, we have a long trade, so we need a stop loss. I simply now say, okay, stop loss is here. And let me change the color of that line. So that should be the stop loss of that trade, and now we have a stop loss here. Okay, and that trade, the long trade, gets, for example, a take profit, let's say risk reward ratio about 2, so take profit would be here. But now the question is, what about a trade now mirrored in a complete other sense? And complete other sense to the variant 2 we discussed last week is now quite simple. So now the short trade should be opened at the green line as well. Okay, but that will be now, the upper line will now be the stop loss of the trade, and that red line will be the take profit of the trade. So we really mirror everything. So we mirror stop loss and take profit, meaning what originally for the long trade is the stop loss is for the short trade now the take profit. So that would mean that trade, if you follow an account and in that account that long trade is opened, you open a short trade, and if the leader would go into the stop loss, so the account you follow, you would have a profit. The downside is if the price goes into the other direction and the leader, the one you follow, reaches take profit, then you will be the one in stop loss. But yeah, now you see you have what the other one has as take profit, you have as stop loss. So that is another way of how to mirror trades. And I have done that kind of trading here as well. And I can simply start once again, and you might remember that I can simply start everything within that terminal window, and I can later visualize everything directly here. And what I start here with the parameters set up to now is, for example, that I have now the equity line for a risk-reward ratio of 1. So going back, and we have been through that topic already last week. So in principle, for no spreads, risk-reward ratio of 1, in principle, equity for the sum of all long and short trades should be a flat line. That this is not a flat line around 0 is simply because my worst case principle of whenever I have a candle and I have a trade, so I finally don't know, because I don't use tick data, I don't know if that candle is quite huge, whether the stop loss has been reached first and then fictional later the take profit, or vice versa. So since I don't know which event happens first, I always go for worst case. So I assume that it is the stop loss. And that from time to time happens if we have that huge candle, and therefore we have that kind of behavior. Still, up to now, everything will look the same like last week. So if I only look for the long trades, for example, all the long trades would look like this one. And if I look for all the short trades would look like this one here. So no spread, therefore everything is more or less symmetric. So when the long trades go to the minus, the short trades go to the plus, and vice versa. So far, so good. But now, because we don't have spreads and we have a risk-reward ratio of 1, everything is nearly symmetric, besides the fact of those worst-case trades. But now, simply once again, go for risk-reward ratio of 2. And by the way, the risk-reward ratio of 2 is set for those long trades. For all the short trades, it would be exactly like in my example within the chart, meaning that whenever I have a trade opened in the same situation, the short trade would have a risk-reward ratio of 0.5, simply because what's the stop loss of the long trade is now the take profit of the short trade, and vice versa. So we can have a look to the equity of a risk-reward ratio of always 2 for all long trades. If I simply enter that number here, and let's start with that equity curve here, which is, let's say, neutral, because we have only we have risk-reward ratio 1, and we have no spreads. And now I can plot here the same for the sum of all long and short trades, in a sense that every trade is really mirrored. And okay, does not look that bad. Equity goes upwards, that's fine. But let me change one thing. Let me additionally go for 0.5 risk-reward ratio. So now everything is similar, but for long and short trades exactly vice versa. So I can plot that one as well. And now the equity looks like this. and it goes a little bit to the south. Good. Finally, what I can show you, that the other one we have had last week was quite better. I'll come to that later. But let me change here, for example, the risk-reward ratio to 0.1. And you will see something very interesting in principle, meaning that now the equity will look much better. Like this. Good. Sounds first like, hey, good. Okay, the half of the time since 2004, there was no good results, but all of a sudden, from that point in time onwards, strategy works extremely well. But you see already, I make a pause and there's a big but. What might look good here is not that good. And let me add the spread here for that strategy. And I use the same spread as last week, so 1 BIP. And let's recalculate the strategy with that risk-reward ratio. And then you will see what happens. And that's the final result. Wow. That is disappointing. So adding the spread ruins even that strategy absolutely and completely. Conclusion here, once again, trade mirroring does not work. And I looked for a couple of other values, other risk-reward ratios. It does not work. So my basic assumption, I think, is right. Don't do it. But still, I can not guarantee that there are some certain conditions that it might work. But in principle, it will not work. And that is demonstrated here again. Let me now start what I have done last week already. And the starting point has been that we have had not that bad strategy. Starting now with the other type of mirroring again, so the one that we have, if we have a stop loss of 1% for the long trade, then we use the same 1% for the short trade as well. And the equity line we looked at already last week was this one, starting with risk-reward ratio of not starting, but we look, for example, for the risk-reward ratio of 3, and that was not that bad. So that is even better than all the others we have seen on the variant 1 base. So that was without spread, and now back entering spread as well here. And the equity was not already profitable, but that is now the starting point for further analysis. So, oh, it was not ready. We plot once again. So we have this equity, the green one, with a spread as a starting point for next considerations. So I know equity goes south. Okay, no question. But I see periods. I see long periods, and I see quite small periods where that kind of strategy entering long and short trades simultaneously with a risk-reward ratio of, for example, 3 here, that there are periods with positive equity behavior with spread. And I will later even make the spread higher, will additionally put commissions into everything. So I would go for the, let's call it, the real trading conditions. And yeah, now the question, how can we find a filter which filters exactly the good parts here, always those parts when we have periods of going north. And what I have done, let me first describe a little bit what I have already done. I will show some results later, and I think I will move further into that topic next week because we will not reach the final end already today. So the headline here is searching the edge. We look for the probability advantage which we can use that we finally have really good trades. And my basic assumption here is just one line. Is there a relation between an ROC, rate of change, for a certain period? For example, rate of change period 4 within an M5 chart would be looking back 20 minutes compared to now, and that is the rate of change. Or rate of change period 12 would be the change within 1 hour for M5 base, for M5 data, and so on and so on. So the rate of change is a view or look into the history from now. So it measures, or it gets a feeling of the history of the price. That's all. And the question is now, can we find a relationship, or a good relationship, between rate of changes and real trades? So good trades. Good trades would be finally those trades which are positive. And since we know that all the trades within that kind of framework are simply described by a risk-reward ratio and a multiplier on ATR as a stop loss, so we look finally for rate of changes and trade results. And the edge should be some positive relationship between those two. I don't say really positive correlation because it's already enough if there is some sort or some categories which are positive. So, for example, extremely high risk of rate of change values trigger long trades, for example, with small stop losses. If I get such a conclusion, then I have a filter which I may use for further analysis and for a trading strategy. One remark that what we are doing here is a little bit similar to something we did a couple of months ago, which runs under the name class trading. But now we are doing that more from a statistical point of view, so more from just looking or searching the edge. When I start that kind of analysis, I do it individual for long and short trades. And later I will show some results doing it for, once again, both simultaneously. So long and short trades with same stop loss and take profit simultaneously. But for the meantime, first let's have looks, analysis done for long and short separately. So what does it mean? Simply, what we can start with is, let's start with, in order to get a feeling of what we are doing here, that we use a certain risk of rate period, that we use a fixed stop loss multiplier, and a fixed risk reward ratio. And then let's have a look what happens. Let me show you, and then you will understand what I mean here. For example, I go for this analysis, and you will immediately in a second understand what I mean here with looking for an edge with that kind of analysis. So I have a big Excel sheet here. So that big Excel sheet is simply all trades. So all those trades, in this case for the long side, so all long trades. And I know the value of risk of a rate of change. And by the way, that risk of change I calculate not absolutely. I calculate that rate of change in units of ATRs. So so I know the values, and I know all the trades. So that equity here is still the same one we would have had in our GNU plots previously. So that equity here is all long trades with a risk reward ratio of 3, a stop loss multiplier of 5, a certain trade length, and by the way, in this case, with 1 BIP spread as well. So that is the equity of all those long trades. And now what I have done is, I have, similar to class trading, I have copied all the rate of changes for period 3 here into that column. Then I have sorted those values against the value itself, and I get a picture like this one here. Let me edit this because then you can see it better. Chart type, and let's draw a line because that can be better seen here. So what you have here is what I sometimes call the pseudo histogram of all rate of changes. So there are a few values which are huge to the minus, and there are a few values huge to positive values, and a lot of values in between. And now I looked for limits in order to categorize here 5 groups. Simply 5 groups which have the same number, so the same counting numbers of those rate of changes. And I simply use those 5 categories for now, because everything here is done in Excel sheets. So I have categorized all the rate of changes and the corresponding trades, and you see, okay, this trade in this line here falls into category 1 because I count them 0, 1. So in this category we found exactly that trade because the rate of change falls into a certain interval. And now I can have a look to the equity line filtered, simply filtered into the categories like, so let me start with the blue line here. The blue line would represent rate of changes on a period 3 which are huge to the minus. And now I can realize if we have rate of changes period 3 and the values are huge to the minus, it's not a good idea to open a long trade with risk reward ratio 3 and so on and so on. But you see already on the other side, if I have rate of changes which are huge positive on a period 3 on M5 data, then I get a positive slope for my equity line. Hey, that sounds interesting. So I know now, having huge numbers of rate of change period 3, then it's a good indicator going for a long trade with that specific risk-reward ratio. And I have done a lot of those kind of analysis, and let me simply switch directly to, for example, this one here. Just same story, but now we will look for short trades, and we look for risk-reward rate of change period 72. So 72 is 6 hours. So we look 6 hours into the history, and we look for now for short trades. And what's the picture now? So since the blue line are those rate of changes which are huge negative, then it looks like it's a good time to open a short trade. And now you may think, is that surprisingly? Because it's following the line, so the direction of the history is the preferred direction of the future. That is the conclusion out of those few data points here. Okay, maybe a not that bad conclusion. So it's a little bit like following the trend is a good principle strategy. But not only writing a sentence like that, this is a little bit of a proof of that. So having a rate of change with a huge number in the history is a good indicator that a trade into that direction, because nothing else we do here, because now we open short trades and we have had highly negative rate of changes, in this case period 72, and it confirms that going into that direction, so meaning opening a short trade, is a good idea. And those are, let's call it, real trades. So that equity line is real with spread and so on. I can promise that, because I have done much more already, that I have increased spreads and encountered commissions as well, and still get similar results. So intermediate conclusion, because I'm running out of time, and we go on with that kind of strategy next week. And there are much more and highly interesting results I can present. But let me first go back to my slides here, because then you see what we will do in the next couple of steps. So I have looked, for example, for a fixed rate of change period, fixed stop loss multiplier, and fixed risk reward ratio. But I've done more. I have done steps like variate everything. So not every variate additionally stop loss multiplier, risk reward ratio, and the rate of change period, and look for the behavior of what kind of filtering is working best. And finally, I can optimize even that purpose or that calculations, and then I get the next step of results. So it's already time, nearly 12 o'clock. So we continue with that topic next week, and I can promise it's quite interesting. But as I mentioned in my introduction, those are the numbers of the Lambda strategies at ArgusFX. And by the way, there's an opportunity that everybody can follow those strategies. If you have questions, you just can send me an email as well. So there are 4 strategies running: open range, breakout, euro, Japanese yen, then the class trading strategy, regression, D1, and the open range breakout with the walk forward methodology. And yeah, current standing, quite easy. You see that 3 of the 4 strategies are running positive. There's one strategy which is in the minus right now, but overcompensated by all the others. So looks good. For those Lamda strategies, so we have now a little bit more than 2 months of history, and yeah, those are the results. I can only comment or can show or share those results. And by the way, if you want, you can always have a look on those results by your own, simply going here to the Argonaut of ArgusFX, and with that website here, Argonaut, and then you can see those strategies right away simply by filtering, or if you go directly for Lambda strategies, then you can follow and review those equities more or less online, like here now. So that is, I think that is the one for regression D1. And if you start looking for something, you come to that website, and if you search for Lambda, then you get explicitly those strategy, and of course here we have the same numbers in plus and minus of those 4 strategies, and yeah, pressing one strategy gives you the equity of those live accounts. Good. So the performance looks not that bad. And finally, if you have any questions, just send me an email. We go on with that searching for an edge for based on rate of changes, and I can promise interesting results. But we go on next week. 1 hour is already over, so hopefully I can see everybody next week again. Same time, same place. Have a good time and already a good weekend. Bye-bye.